Hello, everyone. Thanks for joining us on another episode of Dreams to Realty. I'm Sage, your host, and today we have our regular special guest, Susan Farquhar, the Managing Director at Cala Property, and I'll bring her up to the stage now. Hello.
Hi, Sage. How are you?
Good. So nice to see you with no hitches and glitches.
Yeah, hopefully that continues, hey?
Yeah, it's always a bit of uncertainty when we jump on this call. It's like, is it going to connect or isn't it? I'm glad it has today.
Yeah, same.
But I suppose that's with life, you know, nothing's for certain in life. And even when we apply it to investing, there's no certainty that things are going to go the way that you plan. But I suppose that's why you have to prepare for having contingency plans and what happens next if things don't go exactly the way you plan. We can't predict what the overall economic surroundings are going to be as we move on. Like, no one could really see there was going to be a Russian-Ukraine war or a pandemic. So we've really come across some of the biggest issues, risks in investing that were really hard to mitigate. And I'd love to hear your insight on that as we continue now trying to push through these high inflationary times and the cost of living's rising. I'm seeing that the investors are continuing to push through, though. There's no doubt that people are still investing in the market. Looking at some data, I don't know, I'm a creative, but I've learned to love data since talking to you, Susan. I've got this new love for data.
It's helpful, isn't it?
tells a story in a new way.
Yeah.
If I look at this ABS data from June, just quickly with you, it says in June 2023, the seasonally adjusted terms for the owner-occupied housing and the value of new loan commitments, which is really interesting, for construction rose 2.5%, but was lower 33% from a year ago. Purchase of new dwellings fell 1.2%. But it said that the investors, the people that were wanting to invest in property, grew by 2.6%, I think it is. So that's good news that people are still dipping their toes in. So where do we start? There's a lot of things happening. I think recently the inflation has come down to 6% and the RBA has decided to hold the rates for another month at 4.1%. The Commonwealth Games won't be going ahead in Melbourne, in Victoria, which is interesting. But there is plans for an Olympic Games in Queensland, Brisbane. I'm noticing that there's a lot of interest in Brisbane for investors, with, above 30% of the investors looking to Brisbane is what I'm hearing from other podcasts. How do things like the Olympic Games impact house prices, Susan, please?
Okay, it's actually very interesting. It can have a really positive effect on house prices. I've also pulled up some data for you. So there was a report that was done by PRD which found that median house prices grew 14.3% in the year after each major event in Brisbane, right? So let's put the games into that as well. And another study found that the Olympic Games increased residential real estate prices by 8.9% on average in 6 host cities between 1984 and 2000. So, it's interesting to see what's going to happen in Brisbane. Now, in terms of Brisbane being a desirable location for investors, I think there's a lot of other reasons for that as well. It's not just the Olympic Games. In fact, the Olympic Games is probably too far away for investors to be overly focused on that right now. I think we've seen the largest net interstate migration in Queensland. Brisbane, obviously, as the capital city, has been a major beneficiary of that, as well as the Gold Coast and the Sunshine Coast. In fact, we're starting to see more movement up the coast as people, particularly living in the Sunshine Coast, are sick of how busy it's become. So they are selling up in the Sunshine Coast after having those huge gains and uplifts in house price value, and moving up to locations such as Hervey Bay and Yeppoon, right? So, as you know, I was in Yeppoon recently and went to quite a few, real estate housing opens, and just to kind of get a feel, it's sort of part of the research that I do, and was really interested to see that, you know, this area that was a relatively small, sleepy town had property going for between 2.2 million and 3.5 million. Now, that is something it kind of almost top anchors the price, where it makes everything else seem a hell of a lot cheaper. I mean, these are stunning properties. These aren't your standard kind of investment grade property. But when you start to see properties go over $1 million, it does really change the flavour of an area and the appetite for investors. And in fact, last year, Yeppoon had the largest growth than any other area in Queensland. So anyway, going back to the Olympic Games, you know, when part of the reason why there can be so much growth in the year after the Olympic Games is because of the infrastructure that is spent in getting that host city up to scratch for the relevant sporting events. Now, when the the International Olympic Committee, the IOC, announced Brisbane, I mean, apart from the fact that there weren't really a lot of contenders because Tokyo was seen as being pretty disastrous. In fact, it's a little bit tricky to work out how successful or unsuccessful Tokyo was. There are some calculations that suggest the Games generated an economic benefit of over $55 billion US. But then other sources show that the Games resulted in a loss of $12.6 billion. Now, given that the whole city was in a state of emergency, I'm probably a little bit more inclined to believe the loss story, mostly due to the lack of spectators, tourism and sponsorships that happened. However, a lot of legacy infrastructure was built during that time, and for that reason alone, I could see that that would have a benefit. When we're looking at the macroeconomic research that goes into pinpointing the right timing to invest in property, so the capital city or region that's set for strong capital growth, infrastructure is a really important part of that, right? So if you have Games that is creating a lot of new infrastructure that will end up being legacy infrastructure, you can see that you just throw that into the mix of your macroeconomic data. Now, in the case of Brisbane's announcement, part of the reason why the IOC did choose Brisbane is because it didn't need a whole lot of infrastructure to be completed or built to cater for the Games. In fact, it wanted to make sure that it was not going to be another loss, because there have been some shocking losses. London, Greece, Rio have been run at an economic loss. So it's Brisbane and the Gold Coast have had Games before, so it already has a huge amount of infrastructure, and those cities. In fact, somebody said in the recent commentary about the Commonwealth Games in Melbourne, said that the Gold Coast is ready to host that now, right? Because they've done it recently, so they're ready to host it now if they wanted to, without it being a huge cost. In fact, some of the infrastructure that was promised for the Commonwealth Games for the Gold Coast was completed afterwards. So, there's a lot more infrastructure there now than what was catered for a few years ago. So that's interesting, I think. So what is going to be the economic benefit of the next Brisbane Olympic Games? I think the majority of the new infrastructure that is getting built is in Redland Bay. There's a new water area marina upgrade, and I think there's regattas and whitewater rafting and that sort of stuff is going on in Redland Bay. And then the Sunshine Coast will be a huge beneficiary. There's quite a few big pieces of infrastructure getting built there, as well as an Olympic City. So for the athletes, so the athletes' accommodation in the new Sun City or Maroochydore. Brisbane will have some upgrades to some of the existing infrastructure like Woolloongabba, but I don't think it's going to have too much new infrastructure that gets built, and I don't think the Gold Coast requires anything new. So because it's already had that amount of build. So I don't think there's going to be as much as an uplift post the Brisbane Olympic Games, other than the interest that is generated from tourism and trade, right? And we've touched on this a little bit in the past, like where are the new migrants coming from? Where is the new tourism being driven from? Events like the Olympic Games, more so than the Commonwealth Games. The Commonwealth is far more regional, but the Olympic Games will bring a whole lot of people to Australia who have had Australia on their bucket list and just go, well, let's tie it in with the Olympic Games and let's go to Brisbane. And they may not even come to Sydney or Melbourne or Adelaide, Perth, right? They might just go to Brisbane and explore Queensland and have an idea that they want to buy something here or they want to come back here, and having that economic contribution from tourism trades, where there is sporting specific legacy can be in it attracting elite training facilities, and that sort of elite sporting economy is relevant. But then, while there can be an uplift, like that original data that I spoke to you about with Brisbane, it's very difficult to isolate what is a direct result from the Olympic Games or the Commonwealth Games and what is just the infrastructure spend and the macroeconomic drivers that led to that timing, getting that timing of the market right, essentially, which we've discussed before. So yeah, there's a lot. I know there's a lot in that, and there's a lot in that question. But yeah, I think that it's not certain. I think that there can be a huge economic contribution from, the couple of weeks that it's on. There is a huge amount of tourism influx, not just from the people spectating, but from all of the athletes and their teams and government officials and sporting officials that come over for the games. That has a benefit. There can be trade benefits from that as well. But in terms of housing prices increasing, chances are it probably will. But at the moment, there's a lot of interest in Brisbane. I think just there's a huge a huge positive net interstate migration into Queensland that has been happening for over a decade, right? It's a technological push where there were technology opportunities to move away from the capital cities, and the pandemic really accelerated the growth of that technology where, a lot of banking institutions and insurance companies, for example, and even like some of the, top 20 companies had this idea that, work from home is probably a good policy, particularly in attracting quality female candidates who need to fit around, have a bit more flexibility in their schedules, but weren't ready for it and were kind of planning for it to be about 10 years away. And suddenly that was all rushed with the security and the technology to have that pretty much ready to go within 6 months, right? So, and that's remained. There are some companies that are requiring their staff to come back to the office, but many aren't, and many know that they probably can't. They just have to. It's the new way of being. It's the new norm. To work around that.
Thanks, Susan. I heard that they're building a metro line, a new public transport line in Brisbane to accommodate the games. That will probably be hopefully rising the prices of some property that are on the line. But looking at more data, apparently West End.
Also,
yep.
There's also an adjacent railway line that's going from Brisbane up to the Sunshine Coast, and that's going to be fantastic as well. That's going to, make a whole lot of other places closer than what they were before, and take traffic off the road, which is great because the Bruce Highway there's a $1.8 or $1.6 billion upgrade to the Bruce Highway happening right now. But there's a lot of traffic. There's been such an increase in population to that area.
Yeah, I think looking at, suburbs that are sought after in Brisbane, West End is one of the most popular, and people are really keen to live around that inner city within 5 kilometres of the inner city. And what I heard was that there could be up to 300 people looking at each listing in West End, which is really interesting because that's going to affect how you place your offers, basically. If there's that much competition, you might be wanting to put in a high offer, I suppose. But if there's less competition for a property, you could sort of, hold back a bit and not push so hard. So that's interesting to look at how many other people are also vying for the same sort of properties. But I guess in Brisbane, you might also need to look at the weather factor. I mean, they did have some bad storms there right in the city. So you'd want to look at flood zones and things like that. I think Balmoral and Hamilton, not sure exactly how far away from the city they are, you might know, but they can be prone to flooding. Yeah. Do you think flooding's going to be a problem for the Olympics?
God, I hope not. That'd be tragic, wouldn't it? Look, I know when we were first recommending Brisbane 9 years ago as a company, at that point in time, there was $310 billion in the pipeline for infrastructure. And I know, and that was a mixture of government and private money. And most of that has been completed now. Like that was 10 years ago that we were talking about that. But that was kind of the first time that people were interested in investing in Brisbane again after the 2012 floods. So I started Cala Property in 2014, and it was 2011, 2012 that a lot of infrastructure was being directed towards stormwater drainage and also building codes. So hopefully that, because the going down, but the water rising up, the banks of the Brisbane River broke in a number of areas. The ferry stops were washed away, and the technology now that goes into some of those ferry stops is mind-blowing. They've got like these hydraulics that elevate them and angle them like on an arm that can angle away out of danger, and it's really extraordinary. So it's look, I'd like to. Who knows, right? It's the weather's so unpredictable and increasingly unpredictable. But I do know that there was a lot of infrastructure spent on upgrading stormwater drainage, and any new buildings had to have an increase to the diameter of the drainage pipes, right? So all of the civil works had a lot more consideration for flooding and for getting the floodwaters away from the properties. There were changes to building codes as well, where residents couldn't be at ground level. They had to be, I can't remember exactly what the height is, maybe 4 metres off the ground. And at what we found in West End is a classic case in point. A lot of the new buildings actually have commercial property underneath. So that at least it's just one or two commercial properties that will get wrecked rather than a whole stack of residential. There was also a lot of technology that went into the car parks. Some of it was quite simple, like having a little, almost like a speed bump to go down into car parks. And I think about the Woolworths underground car park at Fortitude Valley, like in the gasworks. You go into that car park and you go over a speed bump and down. And the point of that is to just have that little bit of a barrier to floodwaters coming in. There's also a lot of like big extractor fans to dry out car parks and to extract water as well. So there's a lot more technology that's going into the buildings that are specific for these kinds of weather events. And, hopefully that does help to mitigate the risk associated with these weather events. But yeah, whether I think the games could be affected by flooding, you'd have to ask Nostradamus.
Wow, thank you. I wasn't expecting that, Susan, but you've just come out with a lot of really valuable information there about the technology that's going into, hopefully mitigating
part of our research stage.
Wow, that's amazing. Yeah. Thanks for that.
Yeah.
But I've noticed, looking at the data again, unit markets of Perth, Melbourne and Brisbane have had the fastest rate in rental growth of late. So I don't think the weather is deterring people from entering Queensland at all. So just taking a look at last week's episode, we touched on not last week, last fortnight. How quickly does 2 weeks go? Seriously. We touched on a huge subject there, the homelessness issue, the housing supply. And, just because we're moving on doesn't mean we're not thinking about it in the back of our minds. It's such a pertinent issue. And I think Chris Minns, he slept out in the cold one cold June or May night, and he experienced it for himself. And I remember writing on his profile, well, Mr. Minns, in London, they actually let all the homeless people sleep in the buses overnight. Will you let people do that here? And I don't know if people are using AI to design a property yet to have a play with, but I've seen these properties where they've got these huge double-decker, triple-decker buses almost, and people are, thinking about living in these sort of camper vans and moving around and finding innovative ways of staying off the streets. But this is just a dream, an illusion as yet. But I really hope it doesn't get to that. It just seems that the government's not doing as much as they could. And I'm just wondering why they keep the supply of housing less than what the demand is. Is it to drive the prices up? Is that the logic that they're working with? Because Australia has seen immense wealth, over the years with their property rising. And I'm wondering if that's what they're trying to do, build wealth for the nation that way. Because 97% of rentals apparently are privately owned and only 3% are community housing by the government. So I'm just wondering why they come up with rules that kind of villainise a lot of investors. I'm catching on to what you say, Susan. I know you've been talking to us a lot about how investors are made out to look like they're greedy, money hungry, sucking blood out of all the renters, but they're actually creating houses for people to live in by investing, and they're really just mums and dad investors trying to get ahead in life and not to be a burden on the government as they retire. But why did APRA make it back in 2016? I don't know if you could help us understand that there were caps on how much money could be loaned to investors from the banks. And then they were looking at negative gearing being a negative force in the market. Do you have any insight to share on that before we move on to the next question?
Okay, so there's a lot in that. And you're breaking up a lot, so I'm sort of trying to. Am I clear for you?
You are, but sometimes it was breaking out earlier. I'll just repeat that. Sorry.
Yeah. Okay.
I was just wondering why.
Yeah. Do you know what, Paige? I might just walk down closer to the modem. I'm just going to take my computer and
sure.
Walk down with you, because I think it might be at my end. All right.
We're getting a tour of your house here. Is that your house?
Yeah, it's ridiculous. Okay, here we go. All right.
Well, I'm just wondering, because there's been a lot of changes to rules, and now there's also a rental commissioner in New South Wales, and it just seems that there's a lot of changes, but not in the favour of the investors, and it's kind of more in the favour of the renters. And I'm just wondering, from your perspective, how this is influencing the rental market, what these changes in the past have done to affect the current situation, and how does land tax impact rental yield most of all? But wherever you'd like to start.
Yeah. Look, honestly, I think it is a real folly of governments and very short term. I mean, one of the things we did speak about last time was about how the housing shortage it's a systemic issue that has to do with planning and the release of land and then the approvals process. So, there's nothing we can do about that. But, land is not there's such a housing shortage at the moment. Why on earth would you disincentivize investors to build new property that's people can rent, right? And, you know, part of the research that we do is what is the vacancy rate, okay? And then also the cash flows, etc. Because it's really important that when you're investing, you understand not just the opportunities, but the risk. So we go into the flood risk, the fire risk, the crime risk, the vacancy rate, which could affect your cash flow. And yeah, the vacancy and land tax is part of the cash flow as well. Investors that I speak to just feel like they're getting slammed all the time. You know, in 2017, Joe Hockey changed the negative gearing laws, so you couldn't claim depreciation on fixtures and fittings anymore for second-hand property, even if the property had been previously owned for one day. If there was a transfer of title that was from private to private, then you couldn't claim fixtures and fittings. So it had to be a brand new property, which was good for stimulating the construction sector to be building more property and to help clear some of the apartment backlog, because there was such an oversupply of apartments around that time. But yeah, there have been recent changes to land tax in Victoria, and then also transfer duties in Queensland, that not stamp duty, but the transfer of the mortgage, that is making the stamp duty almost in line with New South Wales stamp duty or transfer duty costs. So yeah, it's expensive, you know, it's a shame, you know, because when you look at investors needing to ask for more rent, part of it is to cover the cash flow costs. So, you know, interest rates go up. Well, of course, you know, renters need to help share the burden of the rising cost of the economy and inflation. So, and it's a bit very kind of short-sighted and very tunnel vision to kind of expect that investors should all of a sudden be really benevolent. You know, these are, like you said, these are just mum and dad investors. The majority of my investors earn under $150,000 a year as a couple. So they can't afford to own their own home and another property if all of their rates are going up. They don't have any choice but to increase the rent. But that's not their fault, you know. That's the fault of rampant consumerism in this country. It's the fault of increases to the transactional costs and the holding costs of property. So yeah, land tax has a big effect. So it all does. Stamp duty does. You know, stamp duty can be prohibitive to get into a property, which is also what drives the investor market, because a lot of, you know, a few years ago, for my Sydney clients, rent vesting became a really big thing, because they were just like, well, I don't want to live out west where I might be able to afford, in a suburb I don't know where my friends aren't and my employment isn't. I want to live where I live, but I also know that I can make money from investing in property. So they were rent vesting, and rent vesting means that you rent where you want to live and then you invest to make money. Made sense, right? So yeah, it's but like, you know, they're creating more supply for renters.
I don't understand fully rental yield, because I was looking at the CoreLogic data, the most recent hedonic housing value index, I think it is, and it said that the Darwin dwellings provided the highest rental yield of 6.5% and Sydney the lowest of 3.1%. And I'm just interested in how they reached that figure. Is it the costs involved to get a rental on the market? Is that where yield comes from?
Yeah, it's basically the cost of the property versus the amount of rent that you get per week. But we find that the reason why there is such a difference is that we find that a couple of things in that, but there tends to be an inverse correlation between the expected equity growth and the expected cash flow. So higher equity means lower rental yield. Sorry, I meant rental yield, not cash flow. So higher equity means lower rental yield, and higher rental yield means lower equity growth, right? And so in an area like Darwin, which is a smaller market with, not enough infrastructure, it goes into oversupply pretty quickly. You're not going to get as much growth because it just doesn't perform in that way. I mean, the population of Darwin is only around 120,000. It's half the size of Canberra, right? So whereas Sydney has got a very low rental yield but much higher growth, but also very expensive properties, very big stumbling blocks to getting into the property market because of stamp duty costs. So yeah, that tends to be how it works.
Thanks for that. Yeah, I noticed Domain had some very vigorous figures for Sydney price growth. There was recently they said that Sydney prices in some areas increased by about 10%, and that's the same for Perth as well. However, the CoreLogic data said something much more modest, more conservative, more like 5%, which was really interesting. For my around the inner west, around Marrickville and St Peters, had some big growth in the last quarter, which was quite interesting. But do you know why that would be? Like, can Domain's figures be so different to the CoreLogic data? Is it just different data sets, or?
No, it's crystal balling. It's looking at it can be the way they interpret, whether they're looking at trends data, whether they're looking at historic comparables, how they're plugging in information like interest rates and inflation, but look, it's at the end of the day, it's crystal balling. You don't really know, you can, and a lot of, when there's some changes to interest rates patterns, so when property gets put on hold, then it's about, okay, well, what's going to happen now, right? And usually when interest rates get put on hold, especially 2 in a row, it wouldn't surprise me if those property markets really start to take off again now. Because there's still a lot of cash in the market, right? There's still a lot of liquidity and a lot of people just ready to pounce. So, if they can get the money, they're investing or they're buying.
Yeah, it's interesting to see how it's been impacting Perth's market, which has seen quite a lot of growth over the last year. I think they've grown about 3%. And in some areas, according to this Domain data, up to 10% in some areas. But I think one of the biggest changes after COVID is that people are now willing to invest a little bit further away from their main place of residence. Some interesting data for people that are listening is that people are now willing to even invest, up to 800 kilometres away from where they live, whereas before COVID, it was more like, maximum 200 kilometres. So it's interesting to see how investing behaviour is changing. From your experience, do you see many people investing in building new properties interstate, or do they tend to do that in their own backyards?
I know the majority of my clients invest interstate, and the majority of my clients will never see those properties. So, it's because they get that it's an investment. That we show them everything that they need to see about it. Some of my clients will go up and visit the block of land or go and do inspections or go up there when it's completed. But it's a very, very small minority. I mean, out of hundreds and hundreds of clients that I've helped, probably 5 of them have gone to see their properties. So, and look, the vast majority of my clients are in Sydney and New South Wales, but particularly in Sydney. And Sydney has typically not been overly appealing for my typical investor because the cost to get into the property market is so expensive, particularly stamp duty, and also the cost of the property, and the rental yield is so low that, if you don't understand the cash flow on the property, then you're very much at risk of losing that property before you've experienced the capital growth, because holding on to that property adversely affects your lifestyle. And, if you've got a property that's costing you $200 a week to hold, or $300 or $400, very quickly you're going to go, okay, we might have had some equity here, but it's not really worth it. And out of the 2.05 million property investors in Australia, according to the ATO, 71% of those only own one property. And I think that's probably why. You know, they're not treating it as an investment. They don't have a team around them to support their investment process. They're seeing the property as a home, not as an asset class. You know, Australians love homes, right? So it's very difficult sometimes to kind of get your head around the fact that you're never going to live there. You should be looking at the cash flows, not the kitchens. And yeah, it's a change of mentality, but the majority of my clients will be building house and land property outside of New South Wales, outside of their own backyard.
Well, just from listening to some other podcasts through the week, it's interesting to see the data that they have been talking about. Things like approximately 31 construction companies in Perth have collapsed in the recent months. And they believe because of this, it's actually pushing the price of the existing properties up in Perth. And that could be one of the reasons why the prices have been increasing. But the supply chain and the costs of building in Brisbane have also been having an effect on land there, apparently. And it's been actually making land values decrease a little bit because the cost of building is increasing. That's what some other people have been saying. So it's just interesting to hear these opinions that are being talked about. I'm not sure exactly where your colour insight sits with that. But do you think people are favouring houses over apartments at the moment? I mean, Sydney's market growth has slowed a little bit this month compared to the previous months, but it has still grown. Are Sydney investors looking interstate for apartments instead of in Sydney itself?
Not so much. I think that Sydney investors, if anything, might be more swayed towards apartments in Sydney than house and land, mostly because they're more likely to be built in areas where they might want to live or feel familiar with. And also about 1.5 years ago, it was the first time that the average house price in Sydney was $1 million more than the average apartment price. Okay, and so $1 million is a lot of money, right? And then I think there was a change for, you know, families and people who typically prefer houses to go, you know what, we're not going to whack on another $1 million onto our home loan. Let's find a nice 3-bedroom apartment that has all of the amenities and, you know, it has easier maintenance as well. So we've got more time to spend with the family, with the kids, with each other. So I think there has been a bit of a trend there. I think in terms of investment, apartments, particularly off the plan type apartments, have a very, a very unsavory, feeling for most people. We did find that there are a lot of unscrupulous developers who would get all of the investors to buy off the plan so that they satisfied their pre-sales for finance, but then push out their sunset clause so that they got the finance to build. And then by the time it was close to the building getting completed, they would just hang on to it and then hit that 5-year mark and just go, we haven't completed, we're invoking the sunset clause, here's your deposit back, and then sell it for twice as much. So that's burnt a lot of people because it's, even though they've got their money back, that opportunity cost is gone. And that's a bitter pill to swallow. I think the only time, well, certainly for my cohort of investors, there's been a whole stack of them investing in the Cala Air product, but they're apartments that are already built that are for a very specific cash flow strategy. So that's, it satisfies a very different kind of investor with really high cash flow. Now, the reason why apartments are often desirable for investment is because they do tend to have a higher yield and they're cheaper to get into. So that's a good asset class sometimes for investors. And they feel that if they buy off the plan, then they're securing today's price, but will get the uplift of tomorrow's value. Sometimes that plays out, sometimes it doesn't. There's a lot of risk associated with that. And, we have learnt that it generally speaking, apartments don't hold their value in the same way. And when we're even, recommending the Cala Air product, we're very clear that it's a cash flow strategy. It's not a capital growth strategy. There's other products that are better for the capital growth or for a balanced strategy. But this is a way of getting into the market very quickly because these properties have already been built, and getting that incredibly high cash flow. That also gives them some reprieve in cash flow that to help pay for the rest of their portfolios. So I've got a number of clients that might be on their fourth or fifth or sixth property, but suddenly feeling that squeeze from interest rates and going, okay, we need help with this. And it's part of the reason why I came up with that product, was about how do we do this in a really good, safe way for our investors? That's a whole Cala concierge ecosystem where we know we've got a specialised property manager, property lawyer, interior designer who does all of the fit outs and the design, measures it all up, orders the furniture, gets it delivered, installed. It's a whole system to do that really well. But then to have a specialist property manager who has the technology to leverage the best price per night for our clients with that dynamic pricing model. So, that's working really well. But otherwise, we're not recommending apartments at all.
Wow, that sounds great. I'm sure a lot of people are calling up to find out more about that. So that's called Cala Air. Is that the strategy you were just talking about?
Right.
Fantastic.
Yeah, great.
So, Susan, they've held the cash rate steady at 4.1%. Inflation's at about 6% at the moment. But now they're saying that there still could be the chance of further interest rate increases, that this may not be the peak yet, or maybe we are at the peak, but there could be just a couple more to go. And inflation is now looking to be steadied at their targeted level of 2 to 3% by 2025. Now, they're pushing it out further because previously I think the RBA said about end of 2024, but now they're saying 2025. Yeah. So I'm just wondering how this is going to impact prices. Are we at the start of another cycle, in your opinion? And what do you think caused that slump in the prices back in 2018, 2019, I think it was? What are your insights on this?
Okay, so probably that was a bit of legacy from the Royal Banking Commission. So the Royal Banking Commission really stopped lending for a really long time. It was really difficult for people to get money out of the banks. All of the policies tightened up. The banks were still scrambling on how things were going to change, what legislation they needed to update, or processes that needed changing. And, banks are behemoths, they're big companies. So it can take a long time to institute small changes. Which is, I can't imagine how frustrating it must be when you're a dynamic entrepreneurial type working in a big corporation like that. I think it would be quite frustrating. So I think that was probably part of it. And then, the hints with COVID as well. I mean, COVID, put everything on hold initially, and then all of the prices went up. But in 2018, 2019, it was definitely about the Royal Banking Commission. And in fact, it was the first time that we went into a declining market in a low interest rate environment, right, which shows that there's something else structurally going on. In terms of where we're at now, I actually heard a report from CommBank this morning saying that they think that interest rates will hold now and then decline 1% next year. So I thought that was pretty interesting. What do I think is likely to happen? I mean, it was really, I've been sort of saying all year, really, if I go back to what I know about monetary policy and macroeconomics from a really global scale and how that influences interest rates, especially in relation to inflation, employment, and quantitative easing, which is kind of happening or had happened during the pandemic to just kind of keep the economy going. Now we're paying for that, right? We're trying to rein that in. So what does that mean? I mean, are we at the beginning of a new cycle? I think that it's, I mean, the last time was, I think it was in March when interest rates held. Every property market in Australia went up the next month. So, I can definitely see there's a case of that happening. I don't think that investors went, oh, well, we didn't learn that first time around, so we should stop now because then we had interest rate hikes. But, the commentator for CommBank said that and I'm actually not sure who was making the announcement, but, he said that, we've kind of got everything under control now, and so we can stop increasing interest rates. I don't know. I think there's still an argument for another one, probably around Christmas time, to try to curb that excessive spending that we have sort of reined in a little bit in the last year. It's hard to tell. It really is hard to tell. But what will that mean for property prices? Yeah, I think that, even if we look at, say, a 5 to 10% increase, which is the figures that you quoted before, 5% would indicate that the market's recovering, right? That the market's really starting to rise. So, but also the markets can go back and forth a little bit. So it's a very unusual set of circumstances. So it makes it a lot more difficult to speculate on. But I think there is the case for maybe another increased rise, depending on how the country behaves this month. If there's a sudden influx into the property market, you've also got to look at the timing of the year. September is typically the time of year that, we have spring fever and we get our homes ready and we put things on the market. I think that will be a lot of increase into the market, and also could potentially lead to an interest rate rise in October if that plays out, which it very easily could.
Thanks, Susan. That's really interesting what you said about CommBank saying that they think that they're going to hold the rate steady, because I heard from another expert, they were saying that some of the banks aren't increasing the rates every time the RBA increases them at the moment. They've been holding it steady. And what you were saying about the spring fever, apparently that's already hit. We've had such a mild, sunny winter in Sydney that there's been an increase in listings. Yeah. But I'm just wondering whether that is because of the recent 800,000 or so people that have come off their really low fixed rates to the variable rate of close to 6% and are now doing distressed selling. Could that be the issue, or I don't know?
Yeah, that could easily be the issue as well. Like, talking about the cliff, I don't think there was that. I mean, Australians really do prioritise paying their mortgage over everything else. We saw that there was a decrease in travel by, don't quote me on this, it's been a month since I read this data, but I think it was like 21%. We're making different choices at the checkout. We're buying less meat, less processed goods, less packaged food. There has been a decline in food delivery services and other services like cleaning and all of those sorts of accessory discretionary type spending, like car cleaning and all of that sort of stuff. And there's also been, there was something else there was a big change in our behaviour, and another like 20%. It might have 20% going out to dinner was the other one. So there was a decline of about 26%, I think, in going out to dinner. So that's where we make cuts before we have any changes to our household, right? We are a nation of home lovers, and you see that, when we get bonuses, we go, oh, what can we do to the home? We can redo the outside, or we can get new curtains or carpet. In other countries where they don't spend as much time in their homes, they don't do that. They'll buy a new watch, or they'll buy a new car, or they'll go on holiday. So we are very home driven in our behaviour. But in saying that, distress is distress, right? Not everyone, if you're already in a mortgage where you are the kind of person who isn't going out to dinner, doesn't have a huge amount of discretionary spending, then it might be a lot more difficult to just kind of spend less, it's very disrespectful, I think, when you get the, treasurers of countries saying, oh, just get a better job or, work harder. It's like, well, how do you do that if you're already a cleaner working 60 hours a week across 2 different jobs? You're really going to be walking dogs on a weekend, especially if you don't have a high level of education. There's a lot that goes into that, I think. So, I don't know. I think that there will be a lot more property coming on the market. I think some of the data has been skewed a little bit by the lack of stock on the market, like especially the auction clearance rates. But yeah, I think that it wouldn't surprise me. There are some areas where I had a client who was selling her property on the Sunshine Coast, not so much for this reason, a little bit, but more because, she's getting to that age of retirement, and that was kind of always part of the plan. And we've seen the expected value of that property, or expected price expected at sale go down by 20 to 40 grand just in a couple of months, right? Because there has been more on the market because of that financial distress and mortgage stress. So yeah, just interesting to see how that will balance it out, supply and demand.
Yeah, really interesting. As we start to wind up now, I mean, the unemployment rate's probably the best it's been in quite a while. I think the decade average was about 5.4%, and it's currently, they're aiming for about 4% by the end of the year. So I'm just wondering, at the moment, prices of property are still roughly about 5.3% below what it was April last year. Does that mean, and I know I'm asking you to look into a crystal ball, I'm asking you to achieve the impossible here, but does that mean that there's a chance that it could increase that much in coming months? Is that how you look at it? Because it is below that at the moment, there's a chance it could get there again. And what are the main variables that you notice when looking at suburbs, the ones with the highest price volatility compared to the ones with just more the steady growth? Because I know it does differ quite a lot around Sydney.
Yeah. Okay, so in terms of volatility, there are some areas that are very tightly held properties that often are, in families for a long time. Especially in that sort of 5 kilometre ring around capital cities, that tends to be the case, particularly those green leafy suburbs or waterfront suburbs. There's not so much turnover, but they're often much more expensive suburbs as well. There's a lot more volatility in areas that are, have a lower socioeconomic area because there's a lot of movement in those suburbs. Whereas once you kind of got to the point where you can afford that property in, Mossman or, I don't know, Glebe or Balmain or whatever, you're more likely to stay there for longer unless your family unit changes and you need more room or less room. But less room doesn't usually work. Isn't quite the trigger that more room is, or more room required is. And so what was the other question? Oh, about the prices. Well, we kind of look at that historic data on the property clock, right? So where property prices decline and by how much, and then when they start to increase. And, it is crystal balling, but it's also, there is also a bit of a science to it. It really, a lot of it comes down to access to finance, right? So if you can get access to money, I'm astounded that my sales have increased in the last 12 months, not decreased. And I know that does go against the trend, but I'm not really, people's borrowing capacities might have changed, but their ability to get into property hasn't, right? So the difference between being able to borrow, say, 700,000 versus 800,000 doesn't really change whether you can buy a property or not. I will be able to get your property under 700 or under 800, regardless, right? So, but if, suddenly the banks are very tight and the interest rates are very high and the cash flow isn't going to cover the rates and the the expenses of holding a property, that's when you're less likely to invest in property. But as interest rates decline, markets tend to go up and vice versa, which is why I said, 2018, 2019, that was the first time I had seen housing prices decline in a low interest rate environment, and that had to do with something else, and that was the structural stuff, as I said, right? Similarly, when people talk about the Paul Keating's famous quote, the recession we had to have, where interest rates went up to around 18%. There was a structural reason for that. It really didn't have anything to do with the housing market or consumer behaviour. It had to do with the fact that Paul Keating and Bob Hawke were deregulating the Australian financial markets altogether, and especially the Australian dollar, and pegging it to the US dollar away from the pound sterling, and therefore modernising the economy. And the idea behind that was, a lot of that was to create better trading ties with Asia, who were also pegged against the American dollar, so that it was easier to trade with them. And, what has ensued is 30 years of continuous economic growth. So it was a very badly explained quote, because I think, Paul Keating has been absolutely vilified for that. But I think if Australians really understood what was going on at that time and the benefit to those policy changes and that structural changes, it's been enormous. The way we've been able to bounce back from economic shocks has been pretty extraordinary as a nation. And the other thing was creating that 4-pillar, banking system, creating ASIC and APRA, and having that legislation, those governing bodies, so that we didn't have those cowboys in the market, making our whole system a lot safer and a lot more robust. So, there are lots of different reasons, lots of different things that can affect property markets. But when markets start to turn, it's generally linked to interest rates or some other policy thing, or like the pandemic. The markets were starting to recover. A lot of markets were starting to recover in 2019 after the Royal Banking Commission, and then, it just put the brakes on, right? Just pandemic put the brakes on. Everyone just stopped. But then the federal government introduced the $25,000 building grant, and the whole market just went whooshka like wildfire. And nobody in my industry expected that 25 grand would have been enough to stimulate the construction sector in the way that it did, but it absolutely did. And that's also now created this knock-on effect where there is a real limited land supply, and delays, like the supply chain issues in the Ukraine, and, from the Ukraine, and the pandemic, and a whole lot of other things. Mostly the pandemic, actually, more so than the Ukraine. But, that's created delays, and fixed price contracts have, led to a lot of building, companies being liquidated. And like you mentioned, in Perth, we've seen a lot in Brisbane, a lot in Victoria, New South Wales as well. So it's been a real shake-up of the industry, but not necessarily in a positive way, not actually getting rid of bad operators as such, but not finding better ways of, navigating such an unusual situation, which was the pandemic,
Susan, it's always so valuable to talk to you, and I think that the one thing that we really get from your information is that you've got to be wise about the type of property you choose. It's not just jump in for the fear of missing out, but really do plan what your goals are and then seek that perfect investment property, which Colour Insights, I think, helps people sift out the trash from the pearls from the trash there. But we're seeing that the market's strong. There's, tens of thousands of people, well, at least 10,000 monthly, approximately nationally, jumping into the investment market. So if people are interested in finding out more about how they can achieve their investment goals with you, they can contact you on your website, colourproperty.com.au. Is that correct?
Yeah, that's correct.
Great. Thank you so much again. I just wish that the government does more for affordable housing, because I think the build to rent scheme sounds great, but it's not really affordable housing. I think that's sort of more commercial, high end properties that are coming out of that. But who knows? Hopefully it might turn around.
Thank you, Sage.
Thanks. Until the next time. Okay. Bye.
Bye.